dear students. I am Dr. Simi Khurana from Ajay Kumar Garg Institute of Management, Ghaziabad. Today I am going to discuss Unit 2nd of Financial Derivatives and my topic is future contracts. Future contracts are the customized contracts. Future contracts are the standardized contracts. Future contracts are traded on the future exchange. They are not the customized contract, they are the standardized contract, and it is written here. A future contract is a standardized agreement, it is between two parties, one is buyer or the seller, and the person who is going to take a buying position, we can say that it is having the long position, and the person who is going to sell the future, he is having the short position, and they are traded on the future exchange. They are going to buy or sell the underlying asset. The underlying asset may be anything, it may be the commodity, it may be the agriculture products, it may be the metals, it may be the stocks or anything else, and they are going to buy at a certain date, and that date is in the future, and the price is already decided, and that price is known as the preset price. The future date is called the delivery date or the final date, and the preset price is called the future price. Now let us discuss about the terminology of the future contract. The first one is the spot price. Spot price is that price which prevails in the market right now. The second one is the future price. The future price actually that is agreed upon at the time of the contract for the delivery of an asset at a specified future date. It is decided in the advance when the contracts are going to be made. Then contract cycle, it is the period over which a contract trades. Expiry date can be known as the settlement date, final settlement date, and each and every future is going to be expired at the last Thursday of every month, and it can be carried forward. Then contract size, which is also known as a lot size, and different assets have a different contract size. Then the basis is the difference between the future price and the spot price. In a normal condition, basis is the positive, it means the future price is more than the spot price. Now the next one is the cost of carry. The future price is made up of two components, one is the spot price plus cost of carry. The cost of carry include the storage cost plus the interest that is paid to finance the asset less than the income earned on the asset. Initial margin, next one is the initial margin. Each buyer and the seller who is going to contract, they have to deposit the some amount to the clearing house, and that amount is known as the initial margin. The next one is the mark to mark. In the future contract, at the end of each trading day, the margin account is going to be adjusted relating with the investor gains or loss. If it is gain, then it is going to be added, and if it is loss, then it is going to be deducted from the initial margin amount. Now the payoff of the future contract, there are the two situations, one is the long position and the second one is the short position. In the case of the long position, it means the investor is going to buy the future. In the case of the short position, it means the investor is going to sell the future. I will explain with the help of an example. If the suppose Mr. Ram is expecting a bullish trend in the market. Bullish trend in the market. Then he is going for the long position. Long position means he will buy the future. He will buy the future. Now let us take an example of SBIN. State Bank of India. The spot price of the future is right now 540. This is the price which is prevailing in the market right now, and the future price may be rupees 542. I have already told you that there is a difference between the spot price and the future price. That's why the future price is 552 and the spot price is 540. Mr. Ram is expecting that the market will show the bullish trend. It means in the coming days, the price of the share, that is the SBIN, may be rupees 552. Now we have to do the calculation about the profit and loss. If the price of the future 552, Mr. Ram has taken the long position, it means he has bought the future, and the spot price is 542. This is the spot price of future. Spot price difference is 552 minus 542 rupees 10. This is the difference. This is the profit for Mr. Ram. Now you have to multiply with the lot size. The lot size of SBIN is 1500 multiplied by 10. Rupees 15,000 is the profit for the Mr. Ram, that is the investor, Mr. Ram. Now let us take another example. Mr. Ram is expecting that the market will show the bullish trend. If the market will not show the bullish trend, it will show the market will become bearish. Then what is going to be happen? The reverse condition will happen. Let us explain that thing also. Long position, bearish trend. There is a loss. Long position, bullish trend. There is profit. As we know that long position means buying a future. Buying a future. If reverses happen, as I have already told that the bearish trend will occur, then there will be the loss. This we can do the calculation. Now the SBIN future prices rupees 542 and price after few days is rupees 535. Long position, Mr. Ram has buy the future. Now he buys the future at the higher price, but right now the price is 535. He sell the future at 535. The difference is rupees 542 minus rupees 535. The difference is rupees 7. This is the loss to the investor, that is Mr. Ram. Now you have to multiply this with 1500 multiplied by rupees 7. It's 0075 the 35, 10,500. This is the loss to Mr. Ram. Now short position means selling the future. Selling the future. Again Mr. Sham sell the future When he will be in profit? When the market will show the bearish trend. When the market will show the bearish trend, there is profit. But if reverse is going to be happen and you have to sell the future, then what has happened? If the bullish trend is there and you have sell the future bullish trend, then there is a loss. I will explain this with the help of an example. Again SBIN, future price is rupees 542. Mr. Ram sell the future at 542 and he is bearish in the market. Then what is going to happen? He took the short position, sell the future, and the price after few days is 535. Now he is getting profit. How much? 542 minus 535, it's rupees 7. When you multiply rupees 7, that is with the lot size, that is 1500, then the amount will become rupees 10,500. This is the profit to Mr. Sham. But if the reverse has happened, he has a short position, but the market will go up instead of, it means bullish trend in the market. Then there is a loss. He has sell the future at 542, but the price of the future after some day is 550. Then there is a loss of how much? 550 minus 542. He sell the future at 542 and buy the future at 550. Then there is a loss of how much? It's a rupees 8. Again you have to multiply with lot size, you will get the total amount of the loss. That is 12,000. It is rupees 12,000. This is the loss. The investor has to take the long or the short position only when he is sure that the market will show the bullish trend or the bearish trend. If the reverse will going to be happen, he will not get the profit, he will suffer the losses only. Now next point, that is the characteristics of the future contracts. As I have already said that the future contracts are the highly standardized contract. It means each and everything is decided, lot size is decided, quantity is decided, price is decided, future price is decided, then the exchange is decided, each and everything is decided in advance. Then these contracts are traded on the organized future exchange. At the time when the buyer and the seller enter into the contract, they have to deposit some amount to the with clearing house, and that amount is very helpful for the clearing house to do the adjustment in their profit and loss. Then contract seller is called short and purchaser is called long. Both the parties have to pay the margin. I have already discussed this thing, and the margins are generally mark price daily. If there is a profit, it is going to be add, and if there is a loss, it is going to be deducted. Each future contract has an associated month that represent the month of the contract delivery or final settlement. Every future contract represents a specific quantity. It's come under the category of the lot size. Each and every contract which are listed in the stock exchange have a certain lot size. Now let us come to the functions of the future contract. First one is the hedging function. Actually, hedging is a very important function in the future market. Actually, the hedgers are trying to avoid the risk. They are not ready to take the risk. And generally, let us take an example. In the portfolio, if they have any share, they are going to buy the put option along with that. With the use of the put option, the amount of the risk is minimized. How it can do that thing? Let us take an example of same thing. Suppose again I am taking the example of SBIN. In their portfolio there is a 15,000 rupees, 15,000 shares of SBIN. Now he is expecting that the market will show the bearish trend. What the investor will do? He will purchase the put option. When he will purchase the put option, he has to pay some premium. If the market will come down, then the prices is going to be decided, and the risk is going to be minimized. Traders or participants can hedge their risk or protect from the adverse price movement if the price is going to be changed in the market, that is going to be affected. And here the example is given. A farmer is expecting to produce 1000 tons of wheat in next 6 months. He established a price for the quantity by selling 10 wheat future contract, each being of 100 tons. By selling these future contracts, farmer intend to establish a price today that will be harvested in the future. And the future market is only the market where you can do this thing. It is not possible in the cash market, because in the cash market sales was impossible, because wheat was not in the existence. Hedging is also used in the case of the interest bearing securities, and the different participants of the hedger in this case are the insurance companies, then mutual funds, pension funds, multinational companies. They are going to use the future to cover up the loss relating to the risk bearing securities. The next function is the price discovery function, which is again very important function of the future market. Actually, this price function revealing the information relating to cash market price through the future market. We are going to find out the cash market price. It means we are going to find out the spot prices by using the future market. A trader agree to receive or deliver a commodity or asset at a certain future time for a price which is determined now. Now the relationship is created between the future price and the spot price, and what the trader expect, what the people are going to expect the price in the future, that will be calculated with the help of the future market. Traders also can compare the spot and the future price and do the analysis, and they can decide the optimum allocation of the quantity of underlying asset if for immediate sale or future sales. And this kind of the price discovery is very helpful for the farmers and the producers. Now next one is the financing function. Generally people are doing to do the trade with the help of taking the loan from someone else, and they have to pay the interest for that purpose. And one thing is more, in the financing function they have to pay the interest, and other things the people can scare off their contract anytime. There is no problem of the liquidity in the case of the future contracts. Future contracts are standardized contract, and it is easy, very easy for the lender about awareness of the quality. He knows the quality, what kind of the quality he is going to purchase, what is the quantity and the liquidity of the underlying asset. Liquidity of the underlying asset means they can be scared of any time, there is no problem. You can purchase the future right now, within a second you can scare off if there is a profit in the future. If there is a loss, it depends upon the person to person whether he or she can bear the loss or not. Some people are not bearing the loss up to the certain extent, then they are going to scare off the future within the seconds also. And the lenders are more interested to finance hedged asset stocks rather than unhedged stocks. The hedged asset stocks are protected against the risk of the loss of the value. Now the next function is the liquidity function. Future market is actually deals with the transaction which are matured in the future period. Future period means after some time. Future period means in the case of the future market, we can consider that the last Thursday is the day when the futures are going to be squared off automatically by the exchange. It can be You can easily sell the future whenever you want to sell it, but the last day of the Thursday is fixed by the exchange. It can be carried forward also. There is a liquidity position, I can explain with the help of example. If you want to purchase the share in the market, you have to pay the whole amount, but in the case of the future, you can pay just the margin amount and you can do the trading with the volume of the trade. This can be explained with the help of an example. A speculator estimate a price increase in the silver future market, and the current price, that is rupees 7500 per kg, and the market lot being rupees 10 kg, he buy one lot of the future. You have to multiply 7500 into the 10, the total amount is 75,000. Now what is going to be happen? He has to pay only the 10%. How much amount he has to pay? He has to pay only the 7500, but he is purchasing, then total amount of the share is, that is 75,000. If he will do the trading in the cash transaction, he has to pay the 75,000, but right now how much amount he is paying as a margin, that is called the initial margin, only the 7500, and with the increase in the profit there will be the profit to the investor. In this question is given that he will get the profit of 7500. If the value of the transaction also increase, that is 82,500, and incurring a profit of 7500. It means trader in the future market do business much larger volume than the spot market, and market more liquid. Now let us discuss about the different types of the future market. There are the two types, one is the commodity future market and the second one is the financial future market. In the case of the financial future market, the underlying asset is different. In the case of the commodity future market, our underlying asset is food, grains, metal, vegetable, etc. But in the case of the financial future market, our underlying assets are the debentures, bonds, treasury bills, securities and currencies. Now the next one is the interest rate future. Again, it is a very important type of the future. It is one of the important financial future in the world, and it was introduced in the year 1975. Important interest bearing securities are the treasury bills, notes, bonds, debenture, euro dollars, municipal bonds. And this market is also further divided into two parts. One is a long term and the second one is a short term. Bearing interest securities, a few important interest rate future traded on the various exchange are notional, and these are come under the category of the treasury bills future, euro dollar futures, treasury bond future, treasury notes future. Now the foreign currency future. In the case of this, the underlying asset is going to be changed. Now our currency is the underlying asset, and it was introduced in the year 1972 in the international money market. And the different kinds of the currencies are exchanged here, and there is a proper contract between the different parties, that is the buyer and the seller, and these are the contracts which are undertaken by the importer and the exporters of the companies. Then the stock index futures. Again this is a very simple future. Here the underlying asset is the index, just like a Nifty is the index. A person can take a long position or a short position of the index. Right now the index is around about 17,400. If the person think that the market will show the bullish trend, then he will have a long position, and if the price of the index, if the index will increase, automatically he will get the profit. But if the index is going to be decrease, he will get the loss. And the lot size of the Nifty is 50. Lot size of the Nifty is 50. It means if there is a change of the index of 100 points and the 50 is our lot size, you have to multiply 50 with the 100 and the total profit is 5,000. But if the index is right now, let us take 17,400, this is the index right now, stock index of the India, that is Nifty. if it is increased to 17,500, there is a profit of how much? 100. And the lot size of the Nifty is 50, 50 multiplied by 100, the profit is 5,000. But if there is a law, if the index come to down and there is a bearish trend, that is 350, then there is a difference of 50. You can easily multiply 50 into 50. 50 multiplied by 50, it's a rupees 25. This is the loss to the investor. And there are different kinds of index, that is a Dow. Dow Jones Industrial Average, Standard and Poor 500, New York Stock Exchange Index, Singapore International Monetary Exchange, S&P, Standard and Poor, Crystal, CNX, Nifty.